Many retail traders operate under a misconception about their role in the market. The common belief is that they are actively trading the market based on their own decisions. However, the reality is that the market often operates in opposition to their positions. This dynamic results in the market effectively trading against the retail trader's interests. Price movements, visualized as candle formations, reflect a constant liquidity battle. This battle involves participants buying and selling assets at various price levels. Liquidity refers to the ease with which an asset can be bought or sold without significantly affecting its price. The liquidity battle determines the direction and magnitude of price changes. Retail traders often find themselves at a disadvantage in this liquidity battle. Larger institutional traders typically have more resources and information. Institutional players have advantages due to greater access to capital. Advanced data analytics provide institutional investors with superior insights. Institutional investors benefit from quicker execution capabilities in the market. These advantages create an uneven playing field in the investment landscape. Smaller investors often lack the resources to compete effectively with institutions. Liquidity plays a fundamental role in driving price action in financial markets. Retail traders often lack a comprehensive understanding of liquidity dynamics. This lack of understanding can lead to unintended consequences in trading. Specifically, retail traders may unknowingly provide exit liquidity for larger market participants. Larger players capitalize on the liquidity provided by retail traders to execute their own trades. Thus, understanding liquidity is crucial for retail traders to avoid becoming exit liquidity. This presentation aims to dismantle common misconceptions about market operations. It will reconstruct understanding based on core market mechanics. The focus is on fundamental principles, not motivational content. Market analysis will be based on mechanics, not solely on indicators. Retail traders frequently initiate market positions based on personal beliefs. These beliefs often include assumptions about market behavior. One common belief is that news events directly dictate price movements. Another belief centers on the idea that breakouts will sustain themselves. Some retail traders believe trend lines offer reliable protection for their positions. Retail cycles are influenced by both human intuition and underlying market structures. Beliefs about retail cycles are often rooted in human intuition. Human intuition can sometimes conflict with the actual structure of the market. This conflict may lead to inaccurate predictions or strategies in retail. Understanding the market structure is crucial for effective retail management. Balancing intuition with structured analysis can improve retail decision-making. The retail cycle initiates with retail traders identifying potential opportunities. Opportunity perception is based on pre-selected indicators. News events also contribute to opportunity identification. These indicators and events signal possible profitable trades. This perception forms the basis for subsequent trading decisions. Retail traders analyze market conditions to identify potential trading opportunities. Based on their analysis, retail traders decide to place orders to buy or sell assets. These orders are placed at specific price levels that the traders believe are advantageous. The collective orders from retail traders contribute to the overall market liquidity. Liquidity refers to the ease with which assets can be bought or sold without significantly affecting their price. The accumulation of orders at certain price points can create support or resistance levels. In the retail cycle, institutions often strategically position themselves against retail orders. This counter-positioning allows institutions to exploit the liquidity generated by retail trading activity. By taking the opposite side, institutions can capitalize on price movements influenced by retail order flow. This strategy leverages the aggregated volume and direction of retail trades. Ultimately, institutional counterplay aims to profit from the dynamics of the retail cycle. In the retail cycle, price reversals are common occurrences. These reversals move against the positions held by retail traders. The adverse movement often triggers stop-loss orders. Stop-loss orders are designed to limit potential losses. However, their activation can exacerbate price reversals. This cycle can lead to unexpected losses for retail traders. Retail traders sometimes experience stop-outs from their positions. A stop-out, occurs when a trader's account equity falls below the margin requirements. This forces the broker to automatically close the trader's open positions. Traders often attribute these losses to market manipulation. However, stop-outs can also result from a lack of understanding of market dynamics. Effective risk management and market knowledge are crucial to avoid stop-outs. Retail traders often experience frustration in the market. Despite setbacks, these traders continue to participate in trading activities. This continued participation reinforces a cyclical pattern in the market. A key aspect of this cycle is the provision of liquidity. Retail traders inadvertently supply liquidity to larger institutions. The repetition of this cycle sustains the dynamic between retail traders and institutions. The core function of retail traders is to provide liquidity to the market. This fundamental role remains constant despite technological advancements. Trading tools have undergone rapid evolution over time. However, the underlying cycle of retail traders supplying liquidity persists. The basic principle of retail trading remains unchanged. A common misconception is that retail traders react quickly to news releases. In reality, institutional investors often strategically position themselves in advance. This positioning occurs before the public release of news. Retail traders may find themselves reacting to price movements already influenced by institutions. Therefore, retail traders' reactions to news releases are often delayed compared to institutional actions. A common misconception is that news events directly cause price fluctuations in the market. However, news functions more as a catalyst for liquidity release. News events trigger pre-existing liquidity, influencing market dynamics. Therefore, news acts as a timing mechanism rather than the fundamental cause of price movement. A common myth is that retail traders react impulsively to economic data releases. This myth suggests traders place orders in a single direction immediately following the release. The reality is that market reactions are often more complex and nuanced. Impulsive, unidirectional trading behavior is not consistently observed among retail traders. One common misconception is that market makers passively absorb retail order flow. This myth suggests market makers simply accommodate immediate surges in trading activity. The reality is more complex, involving active risk management and pricing strategies. Market makers do not just absorb orders, they actively manage their inventory and exposure. The claim that certain activities cause a spike in liquidity is a common misconception. This myth suggests institutions can capitalize on these supposed liquidity spikes to execute strategies. However, the existence and predictability of such liquidity spikes are often overstated. The idea is that increased liquidity creates favorable conditions for institutional trading activities. One common myth suggests institutions exploit market spikes for portfolio rebalancing. The myth implies institutions initiate reversals based on predictable retail actions. This strategy supposedly allows them to profit from anticipated retail behavior. The core idea is that institutions capitalize on these spikes to optimize their holdings. Retail traders sometimes struggle to understand unexpected price movements. This confusion often leads to the conclusion that market behavior is irrational. Such perceptions arise from a lack of understanding of underlying market dynamics. Price action is influenced by a multitude of factors beyond simple supply and demand. Therefore, attributing unusual price movements to mere randomness is often an oversimplification. The market's behavior is logical when considered from a liquidity perspective. However, retail traders often operate under a flawed underlying premise. This flawed premise can lead to misinterpretations of market movements. Understanding liquidity is crucial for interpreting market behavior accurately. Retail traders should reevaluate their assumptions about market logic. Aligning trading strategies with market liquidity can improve outcomes. A common myth suggests that support and resistance levels are vulnerable due to clustered stop-loss orders. This vulnerability arises when many traders identify the same support and resistance levels. Consequently, their stop-loss orders tend to be concentrated in similar price areas. The clustering of stop-loss orders creates a potential target for market manipulation. Large players might exploit these clusters, triggering stop losses and exacerbating price movements. A common myth suggests support and resistance levels offer protection to retail traders. However, these levels can actually expose stop-loss orders. Institutional traders may target these areas to trigger stop-loss orders. This targeting can lead to unexpected losses for retail traders. Therefore, relying solely on support and resistance for protection can be risky. Effective risk management requires a more nuanced approach than just setting stops at these levels. A common myth suggests that retail traders' stop-loss orders are seen as accessible liquidity by institutions. This perspective implies that institutions view these orders as a pool of readily available funds. The idea is that institutions can exploit these stop-loss orders to their advantage. By triggering these orders, institutions could potentially manipulate the market. This could lead to profits for the institutions at the expense of retail traders. However, the validity and extent of this practice remain a topic of debate among traders and analysts. The concept suggests retail trader breakout entries are a form of engineered liquidity. This implies price movements are manipulated to trigger these breakout entries. The purpose is to create readily available liquidity for larger market participants. This liquidity is supposedly generated through specific, deliberate price action strategies. The myth posits that these breakouts are not genuine but rather traps for retail traders. The myth suggests retail traders' fear of missing out, FOMO, offers free order flow. This supposedly enables institutions to execute orders at advantageous prices. The idea is that retail FOMO creates predictable buying or selling pressure. Institutions could then exploit this pressure to fill their own orders. However, this view oversimplifies market dynamics and order flow complexities. In reality, institutional trading strategies are far more sophisticated than simply preying on retail FOMO. Retail traders often hold on to losing trades, hoping they will become profitable. This hope delays their exit from the position, creating delayed exit liquidity. Institutions can exploit this delayed exit liquidity to their advantage. By understanding this dynamic, institutions can profit from retail traders' emotional attachment to losing positions. A common misconception is that retail traders hide their risk. In reality, their trading behavior often reveals their risk exposure. Predictable order placement patterns inadvertently publish this risk. This exposes vulnerabilities that can be exploited by more sophisticated traders. A common misconception is that retail traders are at a disadvantage due to limited market understanding. This myth suggests retail traders primarily rely on price charts for analysis. The argument is that focusing solely on price charts restricts their grasp of broader market dynamics. However, this view overlooks the diverse range of analytical tools and resources available to retail traders. Many retail traders actively utilize economic calendars, news feeds, and fundamental analysis in their decision-making. Institutions possess advantages in trading due to various factors. Order flow analysis provides institutions with insights into market trends. Liquidity depth allows institutions to execute large trades efficiently. Inventory risk management helps institutions optimize their holdings. Spread engineering enables institutions to profit from price differences. A common misconception is that institutions must be accurate in their market analysis to profit. However, institutional success often relies on retail traders being incorrect. Specifically, institutions benefit when retail traders are wrong in both the size and timing of their market positions. This asymmetry allows institutions to capitalize on the mistakes of less informed traders. Therefore, institutional profitability is more dependent on retail trader behavior than on perfect market prediction. Retail traders often operate under the assumption that they are competing within the market. This competition involves trying to predict market movements and profit from them. In contrast, institutions employ strategies focused on extracting liquidity from the market. Liquidity extraction involves capitalizing on market inefficiencies and order flow. Therefore, retail traders compete, while institutions strategically extract value. Liquidity is essential for the existence of a market. Without liquidity, trading is not possible. Liquidity ensures that assets can be bought or sold quickly. It also ensures that transactions can occur at stable prices. High liquidity reduces the risk for both buyers and sellers. Therefore, liquidity is a fundamental requirement for a functional market. Liquidity is essential for the execution of trading orders. Without liquidity, orders cannot be filled, preventing traders from establishing positions. The absence of liquidity also inhibits price reversals. Sufficient liquidity ensures that there are enough buyers and sellers to facilitate transactions. Therefore, liquidity is a fundamental requirement for functional trading activity. Absence of liquidity eliminates market trends. Liquidity absence prevents bid-ask spreads. The lack of spreads negates profit extraction opportunities. Therefore, liquidity is essential for market functionality and profitability. Large institutional investors prioritize guaranteed liquidity when making investment decisions. These investors actively seek out zones within the market where liquidity is assured. Their strategy involves identifying areas that can absorb large volumes of trades without significant price disruption. This focus on liquidity distinguishes them from investors who simply follow market trends. High liquidity zones can emerge from retail trading activity. These zones are shaped by the collective actions of retail traders. The behavior of retail traders in these zones tends to be predictable. This predictability is due to the concentration of similar trading strategies. The collective behavior creates observable patterns in price movement. Price movements in financial markets are not random. Prices tend to move towards areas where liquidity is concentrated. These areas of high liquidity represent significant order clusters. The market seeks out and interacts with these liquidity pools. This interaction releases liquidity into the trading system. Understanding liquidity concentrations can provide insight into potential price movements. Buy-side liquidity refers to areas where traders are looking to buy assets. This liquidity is commonly located above previous high price points. Breakout zones, where prices have broken through resistance, also attract buy-side liquidity. FOMO, fear of missing out, entry points often generate buy-side liquidity. These areas represent potential targets for price movement due to concentrated buy orders. Sell-side liquidity refers to the availability of assets for sale in the market. This type of liquidity is often concentrated in specific areas of a price chart. One common location is below old lows, where traders anticipate price reversals. Another area is at support breaks, where prices have fallen below established support levels. Sell-side liquidity can also be found within stop-loss clusters. Stop-loss clusters are areas where many traders have placed their stop-loss orders. Institutions participating in financial markets require liquidity on both the buy side and the sell side. Buy-side liquidity refers to the availability of assets for purchase. Sell-side liquidity refers to the ease with which assets can be sold. Institutions generally prefer the side of the market that offers the maximum number of orders. This preference is driven by the desire to execute large trades efficiently and with minimal price impact. Greater order depth on either the buy or sell side allows institutions to fulfill their trading needs more effectively. Liquidity is essential for efficiently filling large orders. Traders actively search for liquidity sources. These sources should provide minimal slippage during transactions. Slippage refers to the difference between the expected price and the actual execution price of an order. Minimizing slippage ensures more predictable and cost-effective order fulfillment. Fast order fills are essential for institutions. They enable institutions to take advantage of short-term market fluctuations. This speed is critical for maximizing profit opportunities. Fast fills require robust liquidity and efficient execution systems. Liquidity in financial markets refers to the ease with which assets can be bought or sold without causing significant price changes. Emotional participants are traders or investors whose decisions are primarily driven by emotions like fear and greed. These emotions often lead to impulsive buying during market uptrends and panic selling during downturns. Institutions, such as hedge funds or large investment firms, often seek to capitalize on the predictable behavior of emotional participants. Emotional participants provide liquidity by trading based on sentiment rather than fundamental analysis. This behavior creates opportunities for institutions to execute trades at favorable prices by taking advantage of market volatility. Retail traders often supply liquidity at unfavorable moments. This mistiming typically worsens their financial outcomes. Poor timing in liquidity provision can amplify potential losses. Retail traders' actions can intensify market volatility. Their liquidity provision tends to occur at the most disadvantageous times. Retail losses are often attributed to complex market dynamics. However, psychological factors play a significant role in these losses. Understanding consumer behavior is crucial in mitigating retail losses. Psychological triggers can influence purchasing decisions and loss incidents. Loss prevention strategies should address these underlying psychological factors. Focusing solely on market analysis overlooks key drivers of retail loss. Managing small accounts can create psychological pressure. This pressure often leads to over-leveraging as a coping mechanism. Over-leveraging involves using excessive debt to increase potential returns. Consequently, this behavior elevates the overall risk exposure. Frequent trading is often motivated by psychological factors like anxiety and impatience. These emotions can lead to impulsive decision-making in the market. Increased trading frequency creates more opportunities for errors. Each trade carries inherent risks, which accumulate with higher trading volumes. This heightened activity can result in a greater likelihood of incurring losses. Therefore, frequent trading, when driven by anxiety, can be detrimental to investment outcomes. Placing stop-loss orders too close to the current price level is considered a tight stop. Obvious zones, such as well-known support or resistance levels, are common locations for retail traders to place these tight stops. This concentration of stop-loss orders in predictable areas makes them vulnerable to stop sweeps. Stop sweeps are when larger traders intentionally drive the price to these levels to trigger the stop-loss orders, profiting from the forced liquidations. Revenge trading is a psychological phenomenon observed in trading and investment. It is characterized by making impulsive trades, driven by emotional reactions to prior losses. These emotional reactions often include frustration, anger, or a strong desire to recoup losses quickly. Instead of rational analysis, decisions are based on the urge to get even with the market. This behavior frequently leads to poor judgment and increased risk-taking. Consequently, revenge trading typically results in further financial damage and amplified losses. Narrative bias involves relying on compelling stories or market narratives when making decisions. This bias often overshadows objective analysis and factual data. Traders influenced by narrative bias may prioritize emotionally appealing stories over rational assessment. Such reliance on narratives can lead to suboptimal or poor trading outcomes. Objective analysis is crucial for sound decision-making, mitigating the risks associated with narrative bias. Institutions often capitalize on the psychological weaknesses of retail traders. This exploitation extends beyond merely targeting technical analysis vulnerabilities. Retail traders are susceptible to emotional biases that institutions can leverage. Fear and greed are primary emotions that influence trading decisions. Institutions may induce fear through market manipulation or spreading negative sentiment. Conversely, they can stimulate greed by creating artificial rallies or hyping specific assets. Retail traders frequently struggle with self-control in financial markets. This failure often leads to decisions based on emotional impulses rather than rational analysis. Emotional impulses can override logical decision-making processes. Succumbing to emotions can result in poor trading outcomes. Maintaining self-control is crucial for successful retail trading. Institutions begin by identifying liquidity pools in the market. Liquidity pools are areas where a high volume of buy or sell orders are concentrated. These pools often contain clusters of retail stop-loss orders. They also include breakout orders placed at key price levels. Inducement moves are strategic actions in engineering. These moves aim to manipulate a specific variable, often price. The goal is to drive the price towards a predetermined level. This level is chosen to attract increased retail participation. Attracting more retail investors can serve various strategic purposes. Ultimately, inducement moves are designed to influence market behavior. A stop sweep, also known as a liquidity grab, is a trading maneuver. It involves initiating a price movement designed to trigger stop-loss orders. The activation of these orders releases liquidity into the market. This liquidity is released rapidly due to the cascading effect of triggered stop-loss orders. The purpose is often to capitalize on the increased volume and price volatility. Institutions strategically build or net positions in the market. This accumulation occurs during periods of liquidity release. Liquidity is often released during stop sweeps. A stop sweep is when market makers drive the price to trigger multiple stop-loss orders. The execution of these stop-loss orders generates significant liquidity. Institutions capitalize on this liquidity to establish or increase their positions. Directional expansion in engineering refers to a strategic movement of price. This movement is contingent on a preliminary phase of liquidity harvesting. Liquidity harvesting involves accumulating sufficient resources or capital. Only after adequate liquidity is secured does the price shift in the anticipated direction. This directional shift signifies a planned expansion or development. The price movement completes a cycle, indicating the fulfillment of the intended engineering objective. Retail traders often operate under misconceptions regarding price movements. A common mistake is assuming that a price move originates precisely at the breakout point. This belief reinforces flawed trading strategies based on inaccurate assumptions. Understanding the true dynamics of price action is crucial for effective trading. The true price movement in engineering often starts after retail traders' positions are liquidated. This follows a pattern where retail traders are stopped out due to predictable market behaviors. Their exits provide opportunities for larger entities to capitalize on these movements. This exploitation is due to the predictable nature of stop-loss orders placed by retail traders. The real move, therefore, is engineered to occur after this initial phase of retail stop-outs. Before initiating a trade, it is crucial to identify key levels in the market. Assess whether these levels are easily recognizable by retail traders. Obvious levels often attract a high concentration of orders. Market makers may target these levels to trigger stop losses or induce breakouts. Expect a potential sweep or temporary violation of obvious levels. Adjust trading strategies to account for the possibility of level sweeps. The framework involves assessing potential stop-loss order clusters. Identify price levels where numerous stop-loss orders are likely concentrated. These clusters represent potential liquidity targets for price movement. Confirmation of a cluster suggests a level where price may be driven to trigger those stops. Entry point analysis involves evaluating the potential influx of retail traders. Determine if your entry aligns with the anticipated actions of other retail traders. A common entry point with other retail traders suggests a high probability of providing liquidity. Providing liquidity can lead to unfavorable price movements against your position. Therefore, avoid entering positions where you are likely to provide liquidity for other market participants. Exit point analysis focuses on identifying potential trade entry points. The core principle is to determine where other traders are likely to exit their positions. Entering a trade where others are exiting can provide a strategic advantage. This advantage arises from the potential shift in market momentum due to these exits. The liquidity grab check framework assesses potential liquidity sweeps at specific price levels. The initial step is to determine if liquidity has already been taken at the identified level. If liquidity has already been grabbed, the framework suggests reassessing the level. If liquidity has not been grabbed, The framework advises waiting for a sweep to occur. This waiting period allows confirmation of the liquidity grab before further action. Position sizing is crucial for managing risk in trading. The primary goal is to ensure the position size allows for potential adverse movements. Traders must assess their capacity to withstand losses if the trade goes against them. If the potential loss exceeds the trader's risk tolerance, the position size should be reduced. Reducing position size mitigates the impact of unexpected market fluctuations. Effective position sizing is key to long-term trading, survival, and capital preservation. The primary rule is to avoid initiating positions precisely at the breakout point. Instead, traders should wait for a liquidity void to form following the initial breakout sweep. A liquidity void represents an area where prices have moved rapidly, leaving few filled orders. Entering after the sweep allows for confirmation of the breakout's validity. This approach aims to reduce the risk of being caught in false breakouts or retracements. The strategy focuses on capitalizing on the momentum after initial volatility subsides. The market's core function is to facilitate the transfer of risk within the financial system. It also introduces liquidity, ensuring assets can be bought or sold quickly. This liquidity enables market participants to establish positions. The market also helps in balancing inventory across different participants. Overall, the market ensures efficient resource allocation and risk management. Profit is not the primary goal, but rather an outcome. It emerges as a result of understanding and effectively managing a fundamental process. This understanding differentiates successful individuals or entities. Those who grasp the underlying process are better positioned to generate profit. Retail traders often exhibit predictable behavior in the market. This predictability stems from common trading strategies and emotional responses. Retail trader behavior provides liquidity, facilitating market transactions. Institutional strategies can exploit this predictability for profit. Thus, retail traders become targets due to their easily anticipated actions. Professionals secure liquidity through meticulous preparation and strategic planning. A key aspect involves accurately anticipating the behavior of retail traders. This anticipation allows professionals to identify potential areas of liquidity. Trades are then executed strategically to capitalize on these identified liquidity pools. Trading based solely on easily recognizable patterns can be detrimental. These obvious patterns often attract a large number of traders. This concentration of activity can create liquidity traps. By trading these patterns, you are essentially providing liquidity for others. It is crucial to identify and avoid these common traps to protect your capital. Aftermath trading involves analyzing market behavior following liquidity sweeps. This strategy focuses on understanding the system's underlying dynamics. Studying these patterns provides insights into market manipulation and reactions. Successful aftermath trading requires a deep understanding of market mechanics. Liquidity maps provide insights into market depth and potential price movement. Inducement moves are designed to lure traders into incorrect positions. Stop sweeps involve triggering stop-loss orders to create volatility. Building positions like a counterparty requires understanding market manipulation techniques.